The market reaction was pretty interesting. I mean, it all of a sudden reacted. You had yields lower. The dollar came off for like 4.5 seconds, and then we reversed back to the trend that we've been seeing over the last few days. What do you make of that?
So I think there are a couple of things. I mean, one, I would argue for the long end of the interest rate market, which I'm sure we'll talk about, Draghi and what the ECB is doing, I would argue is more important. This doesn't really take the Fed. It doesn't really do anything in terms of the Fed's trajectory yet. As you described, wages were a bit softer. But I do think there's some structural reasons why that's taking place, which we can talk about. But boy, you talk about another 222,000 jobs. The 3-month moving average now is 194,000 jobs. When we're down at a 4.344 unemployment rate, it's almost inconceivable we'd still be there. You know, the one thing that I think when you actually dissect this number, though, it continues to be this extraordinary transition of commerce in the world. It's business services, it's healthcare, professional services. You're taking an economy, the total goods, I think, was 9,000 jobs after construction. Anyway, point being, you're moving this entire economy into such a different way, which just manifested itself again in another employment report.
Now, of course, the Doves are going to talk about the fact that average hourly earnings were 2.5%, et cetera. But if we're in a world where the services jobs are really taking over, they're going to have lower wage jobs versus manufacturing and construction. So do we just need to forget that argument?
So if you take the example of that, so you take year-on-year inflation, what's happening today, year-on-year services inflation in the economy is 2.7%. Goods is 0.47. So you take what's happening with, as you said, there are lower wage jobs that are growing tremendously. People call it reduced productivity. It's just not. We're just hiring, population's aging, incredible amount of healthcare jobs, education jobs, et cetera. It's just a shift of the economy in unbelievably rapid fashion. Listen, I think there's also something in wages that just doesn't get nearly as much attention. The way companies hire today versus the way they hired 5 years ago, 10 years ago, you think about the effect of things like LinkedIn. It's efficiency of jobs. It's just-in-time hiring. We hire consultants, particularly if we're taking on a project. We don't hire full-time necessarily. We can hire for a consultant. It's a completely different framework. They're the traditional Phillips curve. We reach a certain NAIRU, a certain unemployment rate, wages have to accelerate. Anyway, they don't have to accelerate nearly as quickly. So I think people, there's a construct change that's reflective of 2.5% wage growth. It's pretty good.